Hey everyone, welcome back to the channel. Today we're diving deep into one of the most powerful indicators in trading, the RSI. And I'm going to show you something absolutely mind-blowing. How this simple tool predicted some of the biggest market crashes in history, including the 2008 financial crisis, the dot-com bubble, and even the COVID crash of 2020. First, please like and subscribe to grow this channel together. We will continue to make financial freedom for everyone our priority by simple methods and strategies. But here's the thing. Most beginners use RSI completely wrong. They lose money because they don't understand what it's actually telling them. So stick with me because by the end of this video, you're going to know exactly how professional traders use RSI to spot opportunities that others miss. Let's jump right in. So first things first, what is RSI? RSI stands for Relative Strength Index. It was created back in 1978 by a technical analyst named J. Wells Wilder. Now, I know what you're thinking. That sounds complicated, but trust me, the concept is actually super simple. Imagine you're watching a stock price. Sometimes it goes up, sometimes it goes down, right? RSI basically measures the strength of those movements. It looks at recent gains versus recent losses and gives you a number between 0 and 100. When RSI is above 70, it means the stock has been going up a lot, really fast. We call this overbought. When it's below 30, it means the stock has been dropping hard. We call this oversold. Now here's where it gets interesting. The default setting for RSI is 14 periods. That could be 14 days, 14 hours, or 14 minutes, depending on what time frame you're looking at. And this 14 period setting, it's actually predicted some of the biggest crashes in market history. Let me show you exactly what I mean. Let's go back to the year 2000. The dot-com bubble was absolutely insane. Tech stocks were going vertical. Everyone thought the internet was going to make them rich overnight. The Nasdaq Composite was breaking new highs every single week, but if you were watching the RSI, you would have seen something terrifying. In March of 2000, the Nasdaq hit an RSI reading above 80 on the daily chart. Some tech stocks were showing RSI readings above 90. That's extreme overbought territory. Professional traders saw this and started getting nervous. And what happened next? The Nasdaq crashed over 75% over the next 2.5 years. Trillions of dollars evaporated, but the RSI gave you the warning signal. Fast forward to 2007. The housing market was booming. Banks were handing out mortgages like candy. The S&P 500 kept climbing higher and higher. But again, the RSI was flashing warning signs. By October 2007, the S&P 500 was showing extremely overbought conditions on multiple timeframes. The RSI had been above 70 for weeks. It was forming something called bearish divergence. We'll talk about that in a minute, but it was screaming that something was wrong. And then boom, the 2008 financial crisis hit. The market crashed over 50%. Lehman Brothers collapsed. It was chaos. But once again, RSI gave you advance warning. Now let's talk about a crash that's fresh in everyone's memory. COVID, February 2020. The market was at all-time highs. Everything seemed fine. But the RSI on the S&P 500 was sitting above 70, showing overbought conditions. Then, in late February, the RSI started dropping fast, even though prices were still near the highs. This is called bearish divergence, and it's one of the most powerful signals in trading. Within weeks, the market crashed over 30% in the fastest bear market in history. But here's the crazy part. The RSI also told you when to buy back in. By mid-March 2020, the RSI had crashed below 30, hitting oversold levels. That was your signal that the selling was overdone and a bounce was coming. And what happened? The market rallied over 100% from those lows. So you're probably wondering, okay, this sounds amazing. How do I actually use this thing? Let me break down the professional approach. First, understand that RSI is not a magic crystal ball. The biggest mistake beginners make is thinking that as soon as RSI hits 70, you should sell, and as soon as it hits 30, you should buy. That's way too simplistic and it'll get you burned. Here's what the pros do instead. They use RSI as a confirmation tool, not a standalone signal. Let me explain what I mean. When RSI goes above 70, it doesn't mean the stock will immediately crash. In a strong uptrend, RSI can stay overbought for a long time. Think of it like a car's RPM gauge. Just because you're redlining doesn't mean the engine will explode immediately, but it does mean you need to be careful. So what are you looking for? You want to see RSI go above 70, and then you wait for it to cross back below 70. That's when the momentum is actually shifting. That's your signal that the buying pressure is fading. Same thing in reverse. When RSI drops below 30, you don't just buy immediately, you wait for it to cross back above 30, showing that selling pressure is exhausting and buyers are stepping in. But there's an even more powerful way to use RSI, and this is what separates amateur traders from professionals. It's called divergence. Divergence happens when price and RSI disagree with each other. Let me paint you a picture. Imagine a stock makes a new high, higher than its previous peak. You'd think that's bullish, right? But then you look at the RSI and it's actually lower than it was at the previous peak. This is bearish divergence. The price is making new highs, but the momentum behind those highs is getting weaker. It's like a runner sprinting to the finish line but slowing down with each step. That's a warning sign that the trend is losing steam. This bearish divergence showed up before the dot-com crash, before the 2008 crisis, and before the COVID crash. It's incredibly powerful. There's also bullish divergence, which is the opposite. Price makes a new low, but RSI makes a higher low. This means the selling pressure is weakening even though prices are still falling. It's often a sign that a bottom is forming. Now let me give you some pro tips that most YouTube videos won't tell you. Tip number one, use multiple time frames. Don't just look at the daily chart, check the weekly chart, check the 4-hour chart. When you see RSI giving the same signal across multiple time frames, that's when you have a really high probability setup. For example, if the weekly RSI is overbought and the daily RSI just crossed below 70, that's a much stronger sell signal than just seeing it on one time frame. Tip number two, combine RSI with support and resistance levels. This is huge. Let's say a stock is approaching a major resistance level. Maybe it's tried to break through 3 times before and failed. And as it approaches that level again, you notice RSI is hitting 75. That's a double warning sign. You've got technical resistance from previous price action, and you've got momentum showing overbought conditions. That's where professional traders start looking for short opportunities. Tip number three, adjust the settings for different markets. Remember I said the default is 14 periods? Well, that works great for stocks and indices. But if you're trading cryptocurrencies, which are way more volatile, you might want to use a longer period like 21 or 25 to smooth out the noise. For forex trading, some professionals use 9 periods for a faster, more sensitive reading. You need to experiment and see what works best for what you're trading. Tip number four, and this is critical, RSI works best in ranging markets, not trending markets. When a stock or index is in a strong trend, RSI can stay overbought or oversold for extended periods. You'll get faked out if you're trying to fade the trend just because RSI looks extreme. So how do you know if you're in a trending or ranging market? Look at the bigger picture. Use moving averages, look at the overall structure. If prices are making consistent higher highs and higher lows with strong momentum, you're in an uptrend. In that case, focus on buying when RSI dips to 40 or 50 rather than waiting for 30. In a downtrend, look to sell when RSI bounces to 50 or 60 rather than waiting for it to hit 70. Now let me address the elephant in the room. Can you actually make money just using RSI? The honest answer is not by itself. No single indicator is going to make you rich. Professional traders use RSI as part of a complete system. You need to combine it with price action, volume analysis, support and resistance, trend analysis, and proper risk management. RSI is a tool in your toolbox, not the entire toolbox. But when you use it correctly, it's an incredibly powerful tool. It helps you identify when momentum is shifting, when a trend might be exhausting, and when a reversal could be forming. Let me give you a real world example of how to put this all together. Let's say you're watching a stock that's been in an uptrend. It's been climbing steadily for months. You're thinking about buying, but you want to get a good entry. You notice the stock is approaching a previous resistance level around $50. The RSI on the daily chart is hitting 72. The weekly RSI is at 68 and rising. This tells you that momentum is getting stretched. You decide to wait. Sure enough, the stock struggles at $50 and starts pulling back. The daily RSI crosses below 70, confirming the momentum shift. You wait for the stock to pull back to support around $46. As it bounces off that support level, the RSI crosses back above 30, showing oversold conditions are easing. That's your entry signal. You buy at 46.50 with a stop loss below the support at 45. Your target is the previous high at $50. That's a well-planned trade using RSI combined with support, resistance, and risk management. Before we wrap up, let me give you 3 common mistakes to avoid. Mistake number 1, using RSI on low volume illiquid stocks. RSI works best on actively traded stocks and major indices where there's plenty of data. On thinly traded stocks, the signals can be erratic and unreliable. Mistake number 2, ignoring the overall market context. Just because a stock shows oversold RSI doesn't mean it's a buy if the entire market is crashing. You need to consider what the broader indices are doing. Mistake number 3, overcomplicating it. Some traders try to add a million other indicators on top of RSI. Keep it simple. RSI plus price action and maybe 1 or 2 other tools is all you need. So here's what I want you to do after watching this video. Open up your charting platform and pull up a chart of the S&P 500 going back to 2000. Add the RSI indicator with default settings. Now scroll through and look at the major tops and bottoms. You'll see exactly what I've been talking about. You'll see how RSI warned of the dot-com crash, the 2008 crisis, the COVID crash, and even smaller corrections along the way. You'll also see how oversold readings marked excellent buying opportunities. This exercise alone will teach you more about RSI than reading 100 articles. Remember, trading is not about finding the holy grail indicator. It's about understanding market psychology and momentum. RSI is simply a visual representation of that momentum. When you understand what it's telling you, you can make much smarter trading decisions. The crashes are going to happen. The market moves in cycles. That's just how it works. But with tools like RSI, you don't have to be a victim of those crashes. You can see them coming and protect your capital. And even better, you can identify the opportunities when everyone else is panicking. That's what separates successful traders from everyone else. They're not smarter, they're not luckier. They just use the right tools and understand what those tools are telling them. If you found this video helpful, smash that like button and subscribe because I'm dropping trading education videos every single week. Drop a comment below and let me know. Have you used RSI before? What's been your experience? Thanks for watching, and I'll see you in the next one.